I am. Can you hear me?
Yes, thank you. We're missing our leader.
We go check on him.
There he is.
There he is.
Dun, dun, dun.
Okay, I'm in.
Okay, thank you. And Dina, is Paul Bronson in PrimeGov?
No, he isn't.
I'm working on it, Francis.
Okay.
And Culver.
I see Mr. Culver. Where do you see Mr. Culver?
I don't see.
He confirmed he was going to attend, but I don't see him. So.
Francis, do we have a quorum?
Yes, we have a quorum and it's 10 o'clock. Thank you.
Well, then let's get the show on the road. Good morning. Thanks for joining us for the video conference employee retirement system meeting. We have a few announcements to make regarding the video conference meeting. If the video conference is disconnected at any time during the meeting shall be stopped and reconvened once the connection is restored. If communications are unable to be restored within 15 minutes, items remaining for consideration will be continued today, November 12th at 11:30 a.m. via video conference. The agenda and documents are located on okc.gov. Anyone wishing to speak about an agenda item, public hearing, or to speak under citizens to be heard, please call 405-297-2391 or text 405-219-7927. Please provide your name, phone number, the item number, and the reason you wish to comment. If you call in after your item has been heard, you will be allowed to speak under citizens to be heard. Speakers will be allowed 3 minutes to comment. I ask that all participants, except board members, keep their phones on mute until they are recognized to speak. Board members will be allowed to ask questions or comment at any time during the meeting. Okay, so with that, we'll call the meeting to order. Item number 2 on our agenda is to approve the minutes of October 8th, 2020. I have a motion and a second. Please record your vote. Okay, we seem to be kind of hung up here. Oh, there we go. Item passes. Item number 3 on our agenda is the consent docket. We have 3 items. We can take those with one motion. Have a motion and a second. Please record your vote. Item is approved. Item number 4 on the agenda is to ratify approvals. We have 2 items which we can take with one motion. Have a motion and a second. Record your vote.
Ken Culver is now present. Kim, would you please voice vote on this motion? I'm going to ask him to unmute.
Yes.
Thank you.
Item passes. Item number 5 is to approve the claims docket. I have a motion and a second on item 5. Please record your vote.
Mr. Culver, please voice vote.
Yes.
Item is approved. Item number 6 is to receive the report of death, authorize payment of the $5,000 death benefit, and approve continuation of pension to spouse. Have a motion and a second. Please record your vote.
Yes.
Item 6 is approved. Item number 7 on the agenda, receive report of death, authorize payment of the $5,000 death benefit, and authorize secretary to make necessary changes to conform on the following. I have a motion and a second. Please record your vote.
Yes.
Item is approved. Item number 8, receive report of death, authorize secretary to make necessary changes to conform on the following. I have a motion and a second. Please record your vote.
Mr. Culver, how do you wish to vote?
He's muted. I've asked him to unmute.
Yes.
Item passes. Item number 9 is to approve the following applications of vested rights. I have a motion and a second on item 9. Please record your vote.
Mr. Culver, how do you wish to vote?
Yes.
Item is approved. Item number 10 is to ratify approval of the following to terminate vested rights and receive a lump sum distribution of his or her employee contribution account. Have a motion and a second. Please record your vote.
Mr. Culver, how do you wish to vote?
Yes.
Item is approved. Item number 11 is our items for individual consideration. Item A is opportunistic real estate allocation discussion and recommendation and possible vote on commitment to Starwood Distressed Opportunities Fund 12. Good morning, Jason.
Good morning, everyone. Can everybody hear me okay?
Yep.
All right. With me today is Dan Pogue. He's a senior research analyst with ACG and covers private markets. And I've asked him to join us and talk about your real estate allocation and specifically this opportunity with Starwood Distressed Opportunities Fund. So I'm going to pull up my screen. Presentation. Hopefully those of you that are at your computer can see this. Dan, I'll turn it over to you.
All right. Thank you. And slide 7. Am I able to drive here, Jake, or are you driving still?
Well, I am. Just tell me which page.
Okay. Sounds good. And thanks, everybody. Good morning. It's great to be with you. So we have quite a few slides here on the real estate stuff. I'm really going to touch on a handful of them and make sure that we leave plenty of time for the recommendation and make sure we leave plenty of time for Jake to get through his other material as well. But please, as we go through this, as always, stop me with any questions. Always happy to address. So slide 7 here, where we're at, is a great starting point. And really what this shows is just kind of the risk return spectrum across real estate more broadly. So across core, value add, and opportunistic. So both core and non-core strategies. And then how the existing OSER's portfolio maps out across that spectrum. So you can see that the existing portfolio has 3 managers to date, 1 in the core space with Morgan Stanley. That's lower risk, lower return. That's really the foundation for the portfolio. And then in the non-core space, we gradually move up into the right to higher risk, higher return strategies. We have an allocation to TA associates in the value add space and Singular Guff in the opportunistic space. And really the goal here with all portfolios within real estate is to be balanced across this risk return spectrum. And if we look at how we built the portfolio to date, we've done a good job, I think, of achieving that balance between risk and return. And then as we think about this, kind of foreshadows the recommendation that we're bringing forward today. But as we think about how we can continue to complement and add to the portfolio over time, the core allocation, we're essentially at the target allocation of 10%. We have a 5% target allocation to non-core. We're at about 1% today. And so really in the non-core space is where the activity will be over the next few years. And in the very near term, specifically within the opportunistic space, which is where Starwood operates, if we think about the impending distress, we've already seen some of it within real estate, especially within areas like retail and hospitality. But I think that will get worse over the next couple of years before it gets better. And so someone like Starwood, we think, is very well positioned to capitalize on that. And I'll touch on that a bit more as we go. Jake already flipped there, but on slide 8, this just shows the existing performance for the portfolio. Again, Morgan Stanley in the core space, very good since inception performance. It's been in the portfolio about 12 years now, generated outperformance versus the Odyssey Index, which is just the core real estate index that we use to benchmark core funds, generated outperformance of about 220 basis points. I think almost more importantly than the absolute outperformance since inception is that it's been very steady and consistently generating outperformance really across all time periods. And so for the foundation of the portfolio, that steady consistency is something that we shoot for, and Morgan Stanley's done a very good job of delivering that. On the non-core side, again, just 2 commitments to date. The older of the 2 is TA Associates. That fund, as you can see, is largely realized. At this point, it's distributed the vast majority of its total value. If we look at the performance that TA has generated today, that total value to paid in, again, just as a reminder, that essentially means that for every dollar we paid in, TA has given us back $1.61. And so when we think about kind of typical expected return profile for value add strategies like TA, we generally target in that 1.5 times to 1.6 times our money. And so TA in that context has done exactly what we hired them to do. And again, I suspect that fund will be fully realized in the next couple of years. The second and only other non-core commitment that we have so far is a bit newer. It's about 3 years old. That's the Singular Guff fund that you see here today. It is out of the J curve now, which means that there's more value in the portfolio that we've paid in terms of fees. And so performance has trended positive, and we think should continue to trend positive going forward. That fund has called about 2/3 of its capital, but importantly, it's fully committed to underlying investments. So of the roughly kind of $4 million that is still left to be drawn down of that total $10 million commitment, that will solely go to supporting existing investments in the fund, not new investments in the fund. And one reason that's important is one thing that we did want to highlight for the group today is that we did recently discover that there has been some turnover on the real estate team at Singular Guff. There are no alarm bells yet, but it is something that we're actively discussing with Singular Guff to make sure that we just fully understand the situation and that they have a good game plan for how they're going to properly staff and manage the team and the portfolio going forward. We've had multiple discussions with them already. Again, at this point, they are actively working to complement the team that is still in place, that has been there for some time, with some additional mid and senior level hires from experienced real estate professionals that should hopefully be well positioned to continue the high quality strategy that they've had historically. And so really at this point, again, no alarm bells. It's really more of a wait and see approach. We're going to have a couple more calls with them in the next couple of weeks, as well as with some other LPs, again, just to make sure we have full context on how they're going to staff the team, how they can continue to maximize value going forward in that portfolio. And should anything materially negative come out of that, which at this point we don't necessarily think will happen, but if it does, we will definitely come back and keep this group informed as we learn more.
Just another comment here for some of the newer trustees and even the trustees that have been around a while. The core piece, the Morgan Stanley Prime Property Fund, which is really the foundation of the real estate portfolio, it isn't what's considered to be an open-ended core real estate fund, which means it offers quarterly liquidity. So long as liquidity is available, you can put money in and take money out on a quarterly basis. That's different than when we move out on the spectrum into these value add and opportunistic, or the non-core real estate strategies. They're structured the same as your private equity funds, meaning you make a commitment to fund these strategies over time. They call down capital, make investments in properties, improve those properties through lease up or cosmetic improvements to the property, and then sell them. And when they sell them, they return capital to you. So they're not ongoing open-end funds. And so we have to continue to feed this portfolio to get to the target allocation. So that's another distinction that we want to make.
Jake, maybe in that context, we have a lot of market slides in here, but I think in the interest of time and getting to the recommendation, maybe if we flip to slide 14 and we can stick with kind of how we're pacing toward target, that's probably a more relevant discussion. So similar to what Jake was saying here, so I mentioned this, but if you look at present day across TA and Singular Guff, we have a 1% actual allocation. That's the market value of our invested capital that's in the ground today versus the 5% target allocation. And over time, what we use this cash flow model for is to make sure that long-term we can effectively and efficiently build toward our 5% target allocation and maintain that target allocation as efficiently as possible over the long run. And so what you can see here, and this is something too that we regularly update kind of throughout the year with actual cash flow data. So we're always incorporating kind of total portfolio level data as well as real estate portfolio data so that this stays as current as possible. We can track it effectively over time. And so essentially what we're showing here is that to build from the 1% allocation we have today to the 5% target allocation within the next 4 to 5 years, we would need to commit about $15 million each year. Now, keep in mind that that $15 million is purely an agreement to ultimately pay in $15 million. We do not pay that $15 million in all at once because these are liquid structures. Typically, that $15 million will be drawn down over a 4 to 5 year period. And so what that allows us to do and what we can track with this model is that by making those consistent commitments, knowing that the underlying cash flows will be put in over a multi-year period, we can gradually and efficiently build toward that target. And again, we'd expect to hit that 5% target allocation in this scenario within the next 4 or so years. And really, if we think about this last thing I'll say on this, but that $15 million of annual commitments to non-core real estate really equates to 1 to 2 commitments per year. And whether or not we make 1 or 2 really just kind of depends on the manager, the strategy, what the market opportunity is, and more importantly, what the underlying diversification will be for the funds that we may bring forward to this group. Starwood, in this case, which I'll touch on after this, tends to be a very diversified fund, both in terms of geography, the number of underlying assets, and then in the different types of properties that it will invest in. And so what we are recommending in this case is that the entire 2020 budget of $15 million would be committed to Starwood, which we feel comfortable about both because of the rich opportunity set we think that we're going to see over the next couple of years that I already alluded to, as well as the pretty good broad degree of diversification that the fund itself will have. So I'll just pause very quickly there in case there's any questions. If not, we can jump into the Starwood opportunity. Okay. So Jake is already on the slide. I was going to have him, and I know there's a lot of words here, so I'm just going to kind of talk high level on a couple of these things, and then Jake, I'll have you flip to the next slide so we can talk about performance. But Starwood is a new manager relationship for ACG. We have tracked them for a long time. They've been around since the early 90s and have consistently been operating in the real estate space, solely the real estate space since that time. So we've known them for a long time. But it is a new relationship for us, but it is now with Fund 12, which we're discussing here, a broad recommendation across multiple ACG clients. And so as we think about the opportunistic space within real estate today, I alluded to the impending distress that we think we will see over the next couple of years. We think that Starwood, of the various groups in that space, is one of the better positioned groups to actually leverage their experience and take advantage of that opportunity set. And so a couple of the higher level things that we like about Starwood, one I just alluded to, is that they've been around since the early 90s. And so when we think about a strategy like this, we always like to see a manager with experience, but they've had a very strong, cohesive senior team really for the last kind of 10 to 20 years. And that team has invested together across multiple real estate cycles. And so having kind of that battle tested experience in terms of seeing the good, bad, and the ugly within real estate, we think is very important to successfully navigating this next cycle that we think will play out over the next couple of years. So having that experience, you can't buy that experience. You just get it by actually living it over time. And we think that Starwood is one of the more experienced managers in that space, and we place a lot of value on that. And then secondly, I mentioned the cohesive team. But more importantly, on the strategy itself, I mentioned the diversification, but when it comes to capitalizing on distressed real estate, that can come in a lot of different forms. It can come within retail, it can come in the US, it can come in Europe, and as well, it can come in the form of debt or equity. And as we move through the progression of a real estate cycle, the relative opportunity set between the different property types, debt versus equity, et cetera, can vary as you move throughout that cycle. And what Starwood has done a very good job of historically, Jake, if you don't mind flipping to the next slide, is they have been very flexible, as you can see with the two kind of colored bar charts there. They've been very flexible in terms of how they actually invest the money through the various cycles. And so sometimes they can buy healthier properties that are simply mispriced and mismanaged. Other times they can actually buy a distressed asset that maybe was overtaken by a bank because the previous asset owner defaulted on the loan. So there's a variety of ways that they have successfully put the money to work. And as we think about their ability to truly kind of capture the entire opportunity set of distress that we see coming over the next couple of years within real estate, having that broad funnel, that broad scope and experience is something that we think will leave them very well positioned versus some other players in the space that are smaller and may take a slightly more narrow approach to the market than Starwood does. And then lastly, if we kind of combine everything I just said, really what it's translated to is very consistent positive net returns, both in an absolute sense and a relative sense over the past kind of 5 or 6 funds. They did have a little bit of a misstep, just to hit on it, in the 2000 and 2005 fund. That was, both of those funds were really a product of investing a lot of capital leading up to the global financial crisis. And again, when I say that we place value on a manager's experience, they learned a lot of very valuable lessons by some of the poor investments that they made in those funds. And you can see kind of the performance that they've been able to generate coming out of those funds in the last 3 or 4 vehicles. They've really kind of done a good job of eliminating some of those mistakes that they made kind of 10 or 15 years ago, and really generating very stable, very consistent risk-adjusted returns in the more recent funds. And we think that given the continuity of the team, given the consistency of the strategy, they're very well positioned to continue that going forward. And so again, just to be explicit, our recommendation here is a $15 million commitment to Starwood Distressed Opportunity Fund 12 that would fulfill the pacing that we have set out for 2020. And I will pause there for questions.
This is Randy Thurman. May I ask a couple of questions?
Absolutely.
Okay. The first question is regarding correlation to this S&P 500 stock market, whatever. And how does opportunistic real estate compare to prime property on the correlations? My guess is it's even less correlated to the market. Is that correct?
Yes.
Yes, sorry, Jake, go ahead.
Yeah, I mean, this is why we like private real estate overall as opposed to public REITs, just because of the low correlation to markets. These types of strategies in these closed-end vehicles are going to have even less correlation. I think the uniqueness of this strategy is that it is very opportunistic in terms of what they do, and the current market environment that we think that we're certainly in within real estate, where there's a lot of distress, as Dan mentioned, in retail and potentially going to be in office, which gives a manager, well, when those things are negative, it gives a manager like this a pretty significant opportunity to take advantage of those things. So there'll be a fairly low correlation to the rest of your portfolio.
Well, and the opportunistic is less correlated than the prime property. Is that fair?
Yeah, I would think so. Yes.
So even though it's higher on the risk spectrum on the real estate portfolio, arguably it's not as risky when you look at it from a portfolio perspective.
From a portfolio standpoint, it's going to contribute, not much additional risk, and because of low correlation.
Okay,
honestly, the dollar amount is from an overall allocation standpoint, it's pretty small.
Yes. My second question is on the incentive fee. It's 20% after an 8% preferred return, as I read it. How are you defining preferred?
Yeah, so what the preferred return means is that you have to get your capital back plus an 8% annualized return on that capital. And so that's what that preferred return means. So if you pay in $1, you have to get the $1 back. So essentially you have to get $1.08 back before they can take the 20% carry. That's how that works.
Well, $1 back plus 8% annualized return. Is that correct?
Yes.
Okay. And then after that, it's split 80-20, basically.
Yes. Yes.
Okay. Thank you.
And that's very common for this type of strategy.
Yeah.
And those returns that are shown on this page are all in the middle section. Those are net returns, net of fees. So where that shows net IRR, those are net of fee returns.
Thank you.
Jason, this is Paul. Where will we be pulling the $15 million from?
Well, because this is a private, structured vehicle, you're just making a commitment to fund $15 million.
Right.
That $15 million will be called down over the next 3 to 5 years. So it will come from cash and if you're wherever you're overweight.
Overweight.
We don't need to make a decision on that at this point.
Okay, thanks. So we have a recommendation to make a commitment of $15 million to Starwood Distressed Opportunity Fund 12. Any further questions? Hearing none, the chair will entertain a motion. I have a motion and a second. Please record your vote.
Jason, can you quit sharing your screen so we can
Yep.
see the motion?
All right.
Thank you.
Yes.
The item passes. Okay, item number 12 on the agenda is our investment consultant report.
Okay, I'm going to share my screen again, and hopefully I can pull up the right things. Just a couple of things. I'm going to briefly touch on the quarter report and then go to the monthly report. Honestly, I'm not sure I've ever seen a report quite as good in terms of relative performance in a period where things have been fairly choppy. What this is showing, I just pulled up a page from your quarterly report as of the end of September. Over here on the right side, you see the 1 year return, so the trailing 1 year return of 10.3% relative to your policy index, which is up 7.7%. So almost, over 2.5% premium return to the policy index. And I know this isn't your measurement period for your valuation, but it's a 3%, almost 3.3% premium return to your assumed rate of return of 7%. So really, really strong returns. And then relative to other public funds, in the public pension universe, it ranks in the top 12 percentile over that trailing 1 year. And you see over 3, 5, and 10 years, again, very good relative performance and absolute performance. Really, it's come from, well, just touch on a couple other things. We've been able to do that. Obviously, this year has been a pretty wild ride. First quarter, we saw a significant drawdown in the equity markets globally. Your portfolio experienced it as well, although we held up well and protected in that down market. And then we've had an unprecedented bounce back, while fairly narrow through September. Started to see that spread out a little bit, particularly over the last week or so since the election, where cyclicals and more value-oriented sectors have done a little bit better. But that's really been going on since the end of September. But this portfolio, longer term, one of the things we always say, this portfolio is designed to participate in up markets and to preserve capital in down markets. So be down less when markets are down, and up about, and generally speaking, we'd expect to be up a little less when markets are way up. Over time, and we look at this 10-year risk return chart, we're really pleased with these results. So your 10-year return is about 8.6% relative to the policy index at 7.8%, but you've actually done that with less risk or less volatility, by about 20 basis points less volatility. The beta or sensitivity to the markets is a little bit less than the broad market. You see the down capture, you're capturing 91% of the downside, which means if markets are down 10, you're down about 9.1, but you're capturing over this 10-year period almost 100% of the upside. So really pleased with that. As we look at the ASAP, trying to make sure I don't just, as we look at the October report, you can really see where some of this is coming from. And I'll touch on the next oops, the next page. But overall, from an asset allocation standpoint, we're pretty close to targets. As we just talked about, the real estate overall, your real estate target is 15%. That is an area where we're underweight by about 4%. And most of that is this opportunistic or non-core real estate, to which the Starwood would add to that allocation. It's not as easy to move the needle in real estate because of it being private market and illiquid assets. It's not as simple just to take money from equities and put it into real estate. It takes some time to do that. Even within the core real estate in an open-end fund like the Morgan Stanley fund, they can't just take money and put it into that fund on any given quarter if there's not opportunities for them to put money to work. So it's a little bit harder. That said, we've benefited from being a little bit overweight into equities, primarily U.S. equities, which have outperformed non-U.S. over the last few years, although we're starting to see a little bit of divergence there. Nonetheless, you're pretty much at or within target ranges across asset classes. In terms of the relative performance, relative to the policy index, now this is looking through October, that dispersion over the last year has grown even greater. You'll see the 1 year gross of fees at the top line. The total fund is up 8%. Net of fees up 7.5% over the trailing 1 year. That would be the November of 2019 through the end of October of this year, relative to the policy index at 4.7. So that's really what your asset allocation has done if you would invest completely passively, a 4.7% trailing 1 year return. So now we're talking about almost over a 3.5% premium over that 1 year period on a gross basis, and about a 3% or 300 basis point premium net of fees. And it's really coming across the board. You can see your large cap composite relative to the S&P, and your large cap is primarily passive. It's about 50-50 between the SSGA purely passive fund and the Intec strategy. The Intec strategy is a benchmark risk-controlled strategy. It will take some active positions relative to the benchmark, but purely based on a mathematical volatility capture formula, which sounds pretty complicated, but what that strategy tends to do is we'll see that the smaller capitalization names in the large cap index tend to have a higher weighting. And you've really benefited from that over the second half of this year as smaller companies have started to outperform, and you've got about a little over 1%, almost 1.5% premium there in an area where we're not taking much benchmark risk. The two areas that have, or really three areas that have really been beneficial: small cap, long short equity, and then your overall non-US equity, international and emerging components. A lot of that is due to, from an implementation standpoint, while we are style neutral, implementing with growth and value managers, on the US small cap side, your value oriented manager, Earnest, is more of a relative value. They're not really deep value contrarian oriented, which has benefited because the dispersion between growth and value continues to be pretty wide on a trailing 1 year basis. Although, as I've mentioned, quarter to date and since the end of September through yesterday, we have seen a turnaround there as technology in particular has sold off. Some of the more cyclical names have outperformed in financials and energy. But having that more, not a lot of deep value exposure has really helped. Your small cap is outperformed by 10%. The long short equity component, this is the K2 Mauna Kea. It's actually your best performing asset class on a trailing 1 year. So this component actually protected quite a bit in the downturn of the February and March. but it's rebounded quite nicely and much more so than what we've seen with the diversified fund of funds that we were previously utilizing. So up 14.5%. It's actually your best performing asset class. Private equity is lags a bit, which is not surprising. Private equity in the short term, the marks in this portfolio lag public markets, so we wouldn't expect this to be keeping up and just from a mark-to-market basis, as we've seen such a big rebound in the second half of the year. But longer term, your private equity portfolio, and I'm not sure if you all can, I don't know how to, to pull that over, but since over the last 10 years, your private equity portfolio is up almost 12%, which is above the total portfolio. So additive in a period of time where equities have done very well. And then once again, the non-US component, developed markets, a combination of growth and value with Harding Loevner and Lazard. On the value side, Lazard more of a relative value strategy, so down a lot less, and the Harding Loevner growth strategy really outperforming. So as a result of that, you've been able to eke out positive return in a period where returns for overall international developed markets are negative. So adding almost 800 basis points of return. And then the emerging markets, really since February or March, we've seen pretty significant outperformance from emerging markets, some of which, certainly China being a big part of that, as they've moved out of the problems from COVID, at least initially, a little earlier than other areas of the world, and have seen pretty significant outperformance. That overall, your combination there of Wells and Wasatch has benefited you. Wasatch being more smaller cap focused, tends to be more growth oriented, has been a real positive addition. Just on this page, you'll see that Wasatch strategy up almost 20.5%. Versus the EM benchmark up 2.7%. So significant outperformance there. But really, very good performance from across the board. Fixed income, which has been a bit more challenging of an area to keep up with the benchmark, and we've talked about this quite a bit over the last, really the 15 months, beginning with December or January of 2019 through the end of March of 2020, where we saw rates declining. Any exposure outside of treasuries or governments where you had a lot of duration sensitivity was a bit of a headwind. Your portfolios managed that fairly well. So while underperforming that benchmark by less than 1%, we're actually quite pleased with that. We don't have the quarter on here, but coming out since the end of March, your bond portfolio, it's not really reflected on here, but these strategies have actually done well since the end of March. Having more credit and currency and non-US exposure and less treasury exposure has been beneficial over time. So again, really pleased with performance on a relative basis. It doesn't get much better than this. I'd say, probably the most important contributing factor to this is your all's patience and just sticking with the plan. Overall, we expect this portfolio, as I said, to participate in up markets, provide protection in down markets. I think this year we're really seeing the impact of that, because it's been an up and down year, and you've certainly got protection in the first half and probably a little bit more upside than we would expect in the second half. And again, primarily having less deep value exposure has been beneficial over this period. So with that, any questions? I know At the moment, I think the plan is still to get together in person next month. Certainly looking forward to that, despite the what we're hearing in the news. And we're definitely ready to get back and see you all face to face. So hopefully that happens soon, and wish you all a happy Thanksgiving and hope to see you next month.
Absolutely. Thank you, Jason. Okay, item number 13 is comments from board, staff, and citizens. As Jason was alluding to just a moment ago, our December 10th meeting will be in person in the city council chambers. I want to assure everybody that steps have been taken to keep us safe. We have plexiglass dividers on the horseshoe. Francis, you correct me if I'm wrong, but masks are going to be required. And for those of you, the only way to gain entry to City Hall will be through the south entrance. And your temperature will be taken, and as is the case with all the public meetings that are going to resume in person on November 16th, you will have to log in pertaining to your attendance at the meeting. So, did I miss anything, Francis?
No, I believe Regina sent them all the guidelines for public meetings. So if you have any questions, please contact one of us. Paul, as General Services Director, has been very implemental in this process. The doors will be open, Paul, 30 minutes before the meeting for entry.
Yep.
And you'll be allowed to exit any of the doors.
Francis, if I could ask a quick question, it's my understanding that when we get behind the plexiglass sitting in the horseshoe, we can take off our masks. Is that correct?
Well, I'm having that reviewed as we speak by legal. We were under the impression if we had the plastic barrier there, mask would not be needed. But we want to be in compliance with the council and mayor's ordinance requiring masks. So it is still, risk management said it's still recommended that you wear a mask behind the barrier, but it's not required unless ordered by the council ordinance. So, okay.
All right.
Okay, any questions on that resumption of in-person meetings, which for us will be December the 10th? Any other comments from the board? Hearing none, we are adjourned at 10:45 a.m.
Thank you, Paul.
Thank you, everyone.
Thank you.
Thank you.